Henry, let's move on now. Starting fresh, starting new question. Henry says, under which condition rolling the call from a covered call is considered beneficial? Okay, well, when you roll a covered call, it could be in the money or it could be out of the money. What I mean by that, Henry, is let's just take a look at, do I have a covered call? I don't think I do. Let me go back here. I have some naked puts, I think. There's married puts. Let me see what we put in this. Hey, I need a portfolio position. Oh, that was a short put on coin. Okay, that was that position. All right. Okay, let's just put in a position. We'll do it here. I'm going to put in 2 covered calls very quickly. I'm using AIG because it's a married put position that I'm in, and we're just going to say that we bought it 10 days ago at 60.25, and we're going to go ahead and sell the May 27th 55 call. At that time, it would have been about 5.95. That's a guess. It's not an actual number, but we have 5 points and 25 cents of intrinsic value, 70 cents a time premium for the 10th to the 27th, 17-day trade. Might be a little bit high, but we're going to use that one, Henry, okay? Why am I choosing this one? Well, I mean, this is a call that's in the money. We collected $5.95 for it. It's at $168. The stock closed today at $55.62. So I'm looking further out in time. My liquidation right now is a loss of 0.7%. When I had opened this trade, if I'd bought it at 60 and sold this 55 call with the hope to get 1.3%, actually that's probably right around the range it would have been. My hope would have been to be assigned. I sold this in the money call, Henry, to be assigned, make the 1.3% return in 17 days, not married to the position and want to move on. Why would I consider maybe rolling this position now? Well, because if I'm worried that next week the market still be weak and the stock could drop below this price level, my cost basis is now $54.30. If I'm worried that the stock could pull back and next week be trading down to $53 or $54, where my call would expire and I might be a loss on a position, what can I do? Well, I can roll this call down to a lower strike and out in time, roll for a credit, hopefully, so that I further lower the cost basis more and still hope to make a positive percentage return if assigned on the position. Okay, so it's a defensive maneuver is what I'm looking at here. This is defensive maneuver A. Because I got in at 60.25, I was hoping to be assigned and the stock fell. Now I'd go to position actions, Henry, I'd go to position analysis, see the breakdown of my trade. Current liquidation loss is 0.7%. Yes, if the stock holds at 55.62 next week to expiration, I'll make 1.3%, the max expected return if assigned. But down below, we have some rollout opportunities. And not as good as the ones that I wanted, but I see here I could roll down to the July 55 call out in time and keep the same strike for $345. What does that do? That's going to give me a total net credit of $773, and my cost basis on the stock is going to drop down to a little bit below $53. I'm adding protection to this position that is not doing as what I expected. I was hoping the stock would stay at 60 or up and I'd get a sign, but now it's falling close to my short call strike price. I'm worried that I might take a loss. I could just exit for the 0.7%, or I could roll the position out. Now, what I really was hoping to see, and it didn't show up in my rollout opportunities, Henry, so let's go to the what if calculations from the position analysis page. That's going to take us to the profit and loss chart we spent some time with earlier. What I want to do is simulate rolling this down to maybe the 52.50 just for maybe 2 to 3 weeks out in time. So we're here at May 27th. I sold the 55 call. I'm going to click it again, Henry, so that it adds it in. And so we're going to do the May 55 call. We're going to buy it. This is going to simulate essentially closing this position. What do I have left? I have a stock at 55.97 that's trading at 55.62. So that's my 30-cent loss on the trade. But I want to go out maybe another 14. I want to go another 14 days. Now, by 14 days, I mean not 14 days from where I am right now. 14 days from what my expiration was. So we're going to go 21 days out to June 10th. Also go to the regular June 17th here. We're going to go to June 10th. And yeah, the 53, that's pretty good. It's near the 52.50, but it's not offering that strike. So I'm going to use the 53 in this case. So what did we do? We still profited on the initial position, right? Because it was in the money and now the stock fell. We want it to be assigned. We're concerned that it may continue down. So we're going to pocket here almost 430 on that cost basis. And now we're going to sell that new in the money 53 call for 375. This only increases my return by 1.4%, but now my break even is getting lower on the position. Because we took in the 375 to bring it down further. We made 430 of what we expected. Again, there's that net credit of 773 that we were talking about. So we lower the cost basis to 52.22. That's our break even now. I give myself some cushion. So it can be used as a defensive move. Now, in some cases, of course, if I had bought the stock higher, naturally, let's say I had bought the stock at 62.10 and I'd sold an out of the money May 27th 65 call a few weeks ago, and I got maybe 40 cents or so on the position. Let me just add it to the portfolio very quickly, Henry. And where did we put that one in? Was the I need a portfolio? I think it was. Yes, it was. Fantastic. So here's that new position where I sold an out of the money call hoping for appreciation or just to generate a dividend like income on a 10, 14 day trade of 40 cents, lower the cost basis down. But I mean, I'm down huge on this position. We're down 10.3%. Do I want to liquidate and take the 10.3% loss? No, I didn't use it as a married put or a collar, so I'm losing almost 1-to-1 with the stock because we only took it a small premium. Plus, the buyback cost here is still about 38 cents due to increased implied volatility, so I'm not making anything on that call right now. So why would I roll down in this case? To try to get back to break even. I'm sorry, position actions, position analysis. Henry, I'm trying to get back to break even. In this scenario, I'm down 10.3%. Am I going to get back to break even right away? No. What am I looking at here on this chart? I'm looking at the buyback cost of my current option, the new strike prices of the calls here with the new premiums that are available. And I'm looking at this column here, which is the new percent if assigned on the trade. I'm down 10% right now. But if I roll down to some of these strikes here, 57, let's take the 58, and that's out to June 3rd, 14 days away, I'm only getting 73 cents in premium on this position, or 75 cents. But if the stock comes back up to 58, I'm only losing 5.3% on the trade instead of the 10% I'm at right now. Is there anything positive? Not without great appreciation. Here we're already at to June 24th. This is a small premium here of 53 cents. But if the stock goes back up to 62, I get that intrinsic back, so I'm at a gain. But even going further out in time, okay, 62 to July 1st is a 1% gain with another 63 cents. But the stock needs to be trading back up to that level. I'm still negative with these higher premiums. So it's the debate now. And this is more of a further discussion beyond what we're talking about here, Henry. And that further discussion is it better to take this 10% loss if I fear the stock could continue to go down and more losses could be compounded in this case? Or do I need to try to roll down the call in this case to try to start getting into and lowering my cost basis, knowing that I'm probably going to be selling this every 10 to 14 days for maybe the next 3 months or so to try to get back the cost basis, the 5 or 6 points that I've lost on this trade, that 599. I'm sorry, 636 right now, 599 at expiration if the call expires. This was related to that webinar I discussed in the beginning, Henry, one of the ones that we showed last week, the risk of inactions on a position. And what I mean by that in this one, in this one we're looking at here, if I bought the stock at 62 and I sold the 65 call, by the time the stock dropped down to 60, I was probably rolling that 65 call down to 62. And then when it went to 57, I was probably rolling it again to 60. And then it went down to 55, I probably rolled down to 57. I'm trying to get back some of that loss I'm taking on the stock because it's not doing what I want. But again, I also probably had a trading plan in place where if the stock fell 7% from where I bought it, that's probably a signal to me that I was wrong. I should just get out of this position before I take too big of a loss on that trade. Now, all that being said, the reverse is true too. If I had bought the stock at 50 and sold the 52.5 call, Henry, and the stock exceeded my expectations and went up to 55, my call is now in the money. I think it has more room to grow and I want to stay in the position, then I'm going to roll it up and I'm going to roll it out. And I'm going to use this tool to analyze what rollouts and up in prices. I'm going to expect a lower return than I initially had, depending on the buyback cost, but I'm going to try to roll for credit, but I may have to go 2 to 3 or 4 months out in time if I let the position go that deep in the money because I didn't want to be assigned. Okay. All right. And a follow-up to that, Henry, which I don't know if I'll put it in this view with the covered calls. Actually, I'm going to take a small sabbatical, Henry, real quick. We're going to go to the YouTube page real quick. And the reason why I'm here is I want to go to playlists. And you see some of the various playlists here, structure, criteria, ignore that one. I want to go to... There it is. I'm sorry. It took me a minute. There's full playlists here, as you can see, 7 to 8 videos on different strategies as well. There we go. I'm going to view full playlist. So here's where I wanted to go here. Number one, the tools for more in-depth discussion, Henry, than what we just gave you right now. We just sort of talked about when is it beneficial to roll. Well, it's if you're starting to lose money on the position, you think the stock's going to recover, but you want to try to get back to break even. Stock got away from you. Might not be the best approach to use, Henry, but you could do it. But these here, tools for rolling covered calls, we've kind of looked at those already. Triggers for rolling a covered call position. You know, if I sold an in the money or if I sold an out of the money call and the stock started to move against me, what triggers would I use to roll it or adjust it? Here's a good one. Take assignment or roll for that in the money position. When that's gone in the money, do I want to roll up or should I just take assignment, get the return, and maybe re-enter the position? Rolling a covered call that goes against you, to roll or not to roll in the money covered calls at expiration, or to roll or not to roll out of the money covered calls. I don't want to give you a ton of homework, Henry, but go to the YouTube channel, go to the covered calls playlist, and check out some of these for more in-depth discussion on the covered call positions, rolling, when to roll, rolling for a trade that went against you, or one that's in the money, or one that was out of the money because the stock fell against you as well. I want to take some of these are pretty short, 13 minutes, 18 minutes, 12 minutes on the triggers for rolling a covered call there, Henry. So there's a lot of useful information there that I think will really benefit your question on when is it beneficial to roll the covered call.